morning, everybody. Welcome to this month's edition of Growth Basics for Business. My name is Tommy Johnson. I'm with the Portland Regional Chamber of Commerce. Welcome to Eaton Peabody's Growth Basics for Business. This is our monthly breakfast seminar series, which provides a forum to gain useful, do-it-yourself workplace solutions and insightful, actionable tips. And I want to thank Eaton Peabody for allowing us to bring you this virtual event series for the entire season. I'd like to welcome you all to this third installment of the Growth Basics for Business. For calendar 22-23. This is a 10-part season-long series that runs from September through June. Now, today's topic, How Maine's Merging Benefit Market Affects You, is presented by Corianne Quint from New England Financial Services. They're a chamber member that specializes in health and life insurance solutions. They work with small business owners on employee benefit strategies and individuals who are looking for health insurance, disability income protection, and life insurance. Their style is more educational than salesy, and they aim to take away the mystery from life insurance. To learn more about their services, visit newenglandfinancialservices.biz. Now, like all Chamber's virtual signature events, today's presentation is free, and it will be recorded and made available for free replay on the Chamber's website and YouTube page. To keep up to date on all the Chamber's news and events, please visit our website, portlandregion.com, check out our events page, and sign up for our weekly email newsletter while you're there. Now, before we get to today's presentation, I'm very excited to share with some of you who haven't been to Growth Basics yet this year that we're using a new platform. It's called StreamYard for all of our virtual chamber events this year. This platform provides many improved production and interaction elements that I think you're going to be very happy to see. And I'd also like to remind you that if you do have questions for our presenter, please type them in the YouTube chat and we will relay them to our presenter during the presentation. And we will also save some time at the conclusion of the event. And I just want to give a quick shout out to our producer today, Dan Santos, who is our Director of Growth and Innovation. He'll be helping to produce the event for you today. Now, at this point, I'd typically like to acknowledge our presenting sponsor for the Growth Basics for Business, Eaton Peabody. For the past 5.5 years, Eaton Peabody has been the presenting sponsor of this series, and they continue their support this season. This is when I would usually invite Marketing Manager Nate Levesque to say a few words, but unfortunately, he's unavailable today. So I'm going to say a few words on his behalf. He'd like to thank, again, our sponsor, Eaton Peabody, who is a full-service, Maine-based law firm with nearly 50 attorneys serving Maine clients from offices located in Bangor, Augusta, Ellsworth, and right here in Portland. To learn more about their services and the industries that they serve, please visit their website, eatonpeabody.com. Now, on to our presentation. With us today is Corianne Quint from New England Financial Services, someone who I've worked with professionally and brings a tremendous amount of knowledge and experience to the benefits marketplace. Take it away, Corianne.
Thanks, Tommy. And I'd like to thank the Chamber for the opportunity to get this information out to you guys because it's big and important news. So let's get started. All righty. So I am Corianne Quint, as Tommy said, and we have I wanted to get to my introductory slide, but I guess it's in there. So this is educational purposes only. If you are interested in personalized information, feel free to schedule an appointment and I can absolutely drill down and go into the specifics. All right, so my name is Corianne Quint. Tommy, you said it right. I wanted to give you kudos for that. I am a certified employee benefits specialist, and I have that designation through the Wharton School of Pennsylvania and the International Foundation of Employee Benefit Plans. I've been in the benefits business since 1998. I've been account executive with New England Financial Services since July of 2020. I live in Wells with my husband, Bob, my son, Bobby, and our pet pug, Otis. And I do have a grown daughter who lives in Sanford. So I'm very excited to get this information over to you guys because it's big stuff. So why is this important? Well, it's expensive. Health insurance is probably the biggest, next to payroll, the biggest expense that companies have. When we look at the recent Kaiser Foundation, it says if you're looking at in single coverage, the average annual premium is about $7,800. And typical employers contributed 83% of that. So when you're thinking of hiring somebody and you want to take somebody on, you're automatically thinking about how to address this cost. $6,485 for a single person is not a small amount of money. And when you look at what they're for people with families, that jumps up significantly. So it's it's a very real issue everybody's trying to deal with. I thought this was interesting statistics. The companies, we specialize with companies that are 50 or fewer employees, or I should say I do, which you're not legally required to offer a health insurance plan if you're under 50. However, there are a lot of companies that still do, 53% in 2020, of which 48% were 3 to 9 employees. So that's, it's very real, very pertinent. So we've already started seeing some of the changes about what's happening. With these changes that I'll go into detail in a moment, there's a rate increase of 13 to 14% on the individual side, but we're actually seeing across all carriers, on average, a decrease of 2 to 3% for January. And we believe this is largely due to the merged markets and the fact that those carriers are going to have to pay reinsurance that hadn't before, and it's shifting everything into one pool. So the merged markets, this is really the biggest change that's affecting us in the state, and it's worth shouting about, talking about. This is Maine had an insurance market for individuals and then a separate market for the under 50 employees. Well, Maine's a small state, so when you have when you can combine those into one larger market, the risk per person will go down. So this is a really innovative idea. I think it's going to benefit us. I wasn't originally sold on it at first because historically group was always less expensive because of the thought that if you're at work, you are well enough to be a better risk. Where that changed when a lot of small businesses didn't offer it, or people, that were actively at work didn't have another way to obtain insurance, would go to the individual market. So this is pretty exciting. They're also introducing a set of standardized plan options called Clear Choice. Those options are supposed to be pretty much the same core structure. We are finding some minor differences between the plans, but it offers a level of standardization which makes it a lot easier to compare. So that means people that have plans in 2022, they're going to look different in 2023. They're not going to be the same plans, and most plans are going to have some level of differences. So I'm thinking, as we're getting all this new information, do people really know everywhere that you can go to get health insurance? Well, you can get your health insurance direct from a carrier. You can literally pick up the phone and call a carrier, and they can help you get set up. You can use an insurance broker. Insurance brokers are supposed to, part of our role is to know about all the carriers and help match the products to the people, what your needs and what's important to you, style of plans, customer service, all of that. That's what a broker does for you. We go out and do the legwork. Now, brokers can help with other arrangements, like there's the SHOP program, which allows for some potential money back if you meet certain criteria through the marketplace. There's a lot of places where insurance brokers can be very valuable. We are one of them. We're happy to help. I'm coming across a little bit more frequently professional employer organizations, and these are basically organizations that it's kind of like you're outsourcing your employment. You are they legally become the co-employer of your employees. So there's some dangers when you do that, or things to be aware of. You lose a little bit of control when you're assigning your employees over. I've also come across some cases where employer PEOs are not providing the other things that are necessary, like the training. Even though there's an assumption that they take care of all of that, you have to know that that's actually being taken care of. You can't assume that they're going to do it for you. So that's something to be concerned about and aware of with a professional organization. And then there are a handful of association health plans and trusts out there. So like Maine Energy Marketers, one that I was involved with creating, the state of Maine's Credit Union League Insurance Trust for all the employees in the the credit union employees in the state. So there are a handful of them, but they have to be managed appropriately. And a lot of programs have kind of fallen to the wayside because they weren't able to contain costs. But they still exist, and that's an avenue that you can get. So I wanted to open up, all of these options. So, okay, we've got paths to get insurance. What about carriers? What are we looking at? Well, in the state of Maine, we've got only a handful of carriers, Anthem, Aetna, Community Health Options, Harvard Pilgrim, United Healthcare, and new this year is Taro Health. We'll talk about that in a little bit more detail. But these are the only carriers that we have to work with. Now, I know I say only, with all of these programs, the fully insured, there's about 280 different options that we can go through to help people figure out what is the best mix for them. So I sit there and go, okay, well, what's the traditional group insurance pros and cons? Well, need for health insurance is very real, and it's becoming more and more necessary to attract employees. It is a tax-deductible business expense when employers pay for a portion of employee coverage. And if you've got younger employees, composite rating is a benefit. Now, composite is basically an average. So with these standardized plans, where if they're labeled the same, they're supposed to have the same core coverage. So, and they're also supposed to charge the same amount regardless of whether you're an individual or a group. So when you have a group, you have the opportunity to use composite rating, which will give you lower rates if you've got younger employees. Now, vice versa, it also works as a con. If your average employee base is over 50 years old, you're going to be paying more than the average. So let's talk a little bit more about the cons. It's expensive, and it keeps getting more expensive. There are participation requirements. So participation requirements says that of those that are not covered somewhere else, 75% of that population needs to sign up. So if you've got other coverage elsewhere, you don't have to worry because that doesn't count against you. It's really, they want to make sure enough people are insured to make it make sense. And then as a group insurance plan, the employer would pick the plan. So that puts a lot of pressure to pick the right plan for the employee population that you have. There's typically only 1 to 3 choices in a small group too. So those are things to kind of keep in mind. It still has its place, and it still can work in a lot of circumstances, but it's important to know all of your options and what the pros and cons are for each. So we say, okay, that's the group insurance market. How about an individual? Well, the individual market is the same carriers, except we've got Aetna did not participate and United did not participate in the individual market. So if you go to the state of Maine's website, they list there are only these carriers offering comprehensive major medical insurance. So if you think you're getting individual insurance and it's not one of these companies, it's not a major medical that is governed by the Affordable Care Act. So that's a really important thing to know. Individual insurance. Well, why do people want to go in that direction? Well, most recently, it's the availability of federal funding. There's these advanced premium tax credits and subsidies and cost sharing reductions that make these plans much more accessible to people especially in lower income brackets. Because of that help, it makes it a lot easier to afford these plans. And you don't have to worry about picking a plan. Individuals have access to anything that's on the market. Rates are based on age of the individual. So younger folks are going to pay less than older folks. Now, it still is expensive, especially without having any support. Like if you are eligible for affordable employer-sponsored coverage, you cannot have access to subsidies. A lot of people don't realize how that works. I've had a lot of people come to me saying I didn't understand that I couldn't choose between them. Now I have to pay back some of the subsidies, and it was a bad experience. I want to make sure people have a better experience. So if you have access to employer-sponsored coverage and it is considered affordable, you do not qualify for advanced premium tax credits on the marketplace. Now, employers are not permitted to pay for individual coverage. But a lot of people might go, well, wait a minute, I saw something in the news. There is a way for businesses to pay for individual insurance, but it is not permitted for people to just pay for individual coverage. It has to be within an approved structure, such as an ICRA or QSARA. We'll talk about those in a minute. And anybody that is on the older side, I would say even 45 or older, the rates just tend to go up and up and up. So it's great when you're young because it's affordable, but as you get older, it becomes much less affordable. And there's a lot of things that people can do to plans to make them look and feel more like what you're used to. So we like to call these funding arrangements. One that's very popular is health savings accounts. When you have a health savings account, you can open up a tax qualified bank account to pay for future medical expenses. They're great features. I'm happy to go into more detail and talk about any of those features with people if you're interested. Another popular option is a health reimbursement arrangement. That can be a way to have the employer help employees pay for their cost sharing. Could be maybe that they're going to help with the deductible, or maybe they'll help with co-pays. Sometimes there's a little bit of a cost sharing on the front end so that the employee would have like their own deductible, and then the HRA would kick in after that. And those are ways to take advantage of the savings of higher deductible plans, but not take away the coverage to offer that good level of coverage. You also have flexible spending accounts, other tax qualified programs that will help you and give you money to pay for the care. Now, a couple years ago, there was a new program called a QSARA, a Qualified Small Employer Health Reimbursement Arrangement, and that had some initial interest, quite a bit, that people were like, what's this all about? What's this going to do? Well, the second iteration is the ICRA, the Individual Coverage HRA, which that is definitely gaining a lot of popularity, and let's talk about why. I know this slide is tiny and horrible, and I apologize, but it's really kind of a quick picture of the differences between the plans. So the ICRA will work with any size business. So you can offer a group health plan as well as an ICRA, as long as they're offered to different populations of your employees. And there are only certain ways that they can differentiate. Now, QSARA is limited to 50 employees. If you've got 51 employees, the program is not going to work. And so the ICRA can satisfy the large employer mandate to offer insurance as long as it covers at least 95% of your full-time equivalents. So this program, the ICRA, will work in the large group as well as the small group. The classifications that you can differentiate people are pretty limited. You have full-time, part-time, salaried, hourly, seasonal, and this chart says employees must have insurance, but there's really no participation requirements on the ICRA. You're allowed to contribute or not contribute as an employer. You can pay for a portion of their premium, which can differ by age and can differ by family status, but otherwise needs to be consistent across all employees. On the QSARA, there's a limited amount of money that can be put towards the purpose, and there's the annual cap. Typically, it's indexed for inflation. Then next is the big one, that when you have an ICRA, employees can choose whether the employer contribution is better or whether the money coming from the government is better. So again, one of the things that employers have been facing is that they're competing with the federal government for funding. And it's like, why would you spend money on something somebody else is willing to spend money on? So they give you the choice. They can say, all right, employee, if you're going to get $300 from your employer and $800 from the federal government, you get the ability to choose what works best in that situation. Now, for the QSARA, what they do is they reduce the amount of assistance that you get by any contribution from an employer. So if you've got in that same situation where, say, you had $800 made available for the federal government and your employer was going to give you $300, they would basically, $300 would come from your employer, and they would reduce the amount of the subsidy to reach the total. So it would be like 500 from the federal government and 300 from your employer instead of 800 from the federal government. So it really doesn't help the employer because your contribution is lowering the federal government's responsibility, not the other way around. But they do have their place, and they each have some really unique features. So I find that companies that are willing that are looking to just reimburse premiums only, ICHRA is a really good option. Companies looking to do reimburse premiums as well as expenses, then maybe the QSERA would be worth an additional look. You can vary by class with the ICHRA, and it doesn't have the caps, and it does give you an avenue to meet your applicable large employer requirements. And then the QSERA, you want to offer the same allowance to all full-time employees, but you have a variety of insurance situations. So sorry to spend so much time on that, but it's kind of an important distinction. So we go, okay, what else is there? How else can we meet it? Is that all we have to choose from? No, actually, there's a few other options that are important to know about. So one thing that came up, I think I first heard about it maybe 5 years ago, and they're direct primary care offices. So these are doctors that have basically said, we're not going to do the rat race anymore. We don't want to be part of, the current medical situation. We want to do things differently. So they've gone off and created their own direct primary care practices where that's all they do is direct primary care. They typically charge a membership fee to be part of this practice. So then when you have care, you don't pay anything in most situations. So let me go into the pros and cons. So the direct primary care, it's affordable, but there's a reason for it. It does promote strong patient-doctor relationships with these direct primary care practices. You can text your physician, you can call them 24 hours a day. Somebody is usually available at the other end of the line. It's a really unique model, and I think it's worth a lot of people should definitely look at it to know what's coming down the pike. All right, so negative. Well, this really only addresses the primary care need. It doesn't do anything if you need hospitalization or if you need surgery, things like that. This only addresses the primary care need. And having a monthly membership fee, regardless of whether you use the care, can turn a lot of people off, but some people it doesn't. And it hadn't worked with traditional insurance until now. And this is where I'd like to introduce our new insurance company only to Cumberland County. They are hopefully going to expand in future years, but this is kind of their launch. They want to be strong and established to prove that this can work. So they're based out of Cumberland County. They offer plans to individuals and to small businesses. And the way that these work is just so nice. So here's an example of an image that kind of gives you an explanation. So with a typical direct primary care doctor, sorry for getting tongue-tied, you pay nothing when you go to get your care. A traditional primary care doctor usually charges between $75 and $150. With these direct primary care, you get about 45 minutes on average with your physician, where 5 to 10 minutes is traditional market. They assure you, because they handle fewer patients, as you can see in the chart, 500 for these direct primary care practices. A typical office would be 2,500. They make it so that they can assure that you can get an appointment within a reasonable time, and oftentimes within one day. You can text and call your doctor, and they're very accessible. And then when you get your care, because you're paying the membership fee, you don't pay anything when you have a visit. The things that they cover at that primary care level, your labs and your x-rays and even generic drugs, you can pay nothing for. So it's really innovative and a different way of approaching things. And I think you'll be interested in knowing more. So people say, okay, well, it sounds great, but what if not everybody in our office wants to use a direct primary care? Well, they have the clear choice plans that they're required to have on the market. So they're offering 6 plans to start. 3 are specific to the direct primary care piece and utilizing those physicians, and the other would allow you to use any in-network provider. And they've partnered with Maine Health, so all of the Maine Health facilities would be considered in-network. So it's just a really nice approach. So now what else? There's more options. Now, health and sharing programs have been around for a while. And a lot of people have kind of been hearing what's new about this. How does this work? Well, health sharing programs are basically a group of people that have partnered together to believe that they can do better at managing the funds than a traditional insurance company. So yes, these plans can be affordable, and they're not limited by the Affordable Care Act, but that also means they're not subject to the Affordable Care Act. I really like these programs bill things as a need. So if you needed, let's say, knee surgery, typically there would be some pre-op stuff. You'd have your tests. Maybe they make you try physical therapy, and then they say, okay, now it's time for surgery. You might have more physical therapy afterwards, and any post-op care. They take all of those bills, put them together. That's one need. So these plans typically have an initial unshareable amount, which is basically a deductible, but we cannot call it a deductible because it's not insurance. And so each need would have that initial unshareable amount, and the rest would be submitted for reimbursement. Now, it can be paired with an employee assistance program for more comprehensive benefits. We have a couple of programs that we work with that actually utilize that employee assistance program for the preventive care, for your front end type of things. The most important thing about this to remember is it's not insurance. It is a group of people partnering together. They don't cover pre-existing conditions for a series of years. Now, the first year, they don't pay anything. The next year, they typically will bump it up to some degree. These programs would require you to sign either a statement of faith, if it's a faith-based organization, or a commitment to health, basically saying that you're not going to lead an irresponsible life, you're not going to do illicit drugs, you're not going to put yourself in risky situations. And with that, you can participate. So as I said, the fact that it's not subject to the Affordable Care Act can be a pro and a con because it's not required to cover certain things. And there's a certain level of trust. You have to trust the program is going to pay because it's not a legal arrangement. There's the potential that they could deny claims. Now, the companies that we work with have yet to do that, but they always reserve the right to say they can't deny claims if it doesn't fit within the guidelines. So that's another one that we've got, medical sharing programs. I've come across a lot of limited benefit plans as well, supplemental programs. So people will basically take supplemental policies and group them together so that they look and feel similar to traditional insurances. Well, when you do that, yeah, it's affordable because you're paying for separate riders. It's not limited by the Affordable Care Act, but it also means it's not subject to the Affordable Care Act. They don't have to cover things that are required of those ACA plans. Typically, these policies insure only specific risks and dollar amounts. So they might cover hospitalization, or they might cover accident, or they might cover doctor's visits, but it's not all encompassing. So the negatives to these plans is it's not comprehensive coverage. It doesn't cover everything. You have to know what you're buying. And it has the potential for leaving members exposed for additional risks. And as an employer, if you are facilitating coverage, there's a potential liability. If somebody signs up for a program, doesn't know what they're buying, obviously they're going to come looking for who to complain to. So those are things I've come across and things to be aware of. Minimum essential coverage is another thing. I've heard them referred to as MEC plans, minimum essential coverage plans. I don't come across as many of these in the small group market because these are designed specifically to meet the requirement to offer health insurance. So they're going to offer the 10 essential health benefits. Again, they're affordable, but it's kind of like you get what you pay for. And I was trying to come up with other pros for these programs. And I say, well, I guess it's better than going without any coverage. As a negative, it's not comprehensive coverage. It's designed strictly to meet the requirements for the Affordable Care Act and nothing more. And it can leave members exposed to additional risks. So be very careful if you're looking into those things. I'm not saying it can't work. I'm just saying be careful and know what you're buying, which is really a theme on all of these programs. Next one is level funded or stop loss insurance. This has been around for a while, but I'm finding a lot of people still don't know that it exists. So these programs allow you to get money back in good claims years. What you end up with a premium that is closer to what members are actually using. These plans often have a lot of plan design flexibility, so that will allow people to have you can pretty much design a plan, different deductibles, if you want copays, how much those copays are, you've got a lot of flexibility to design a program that works. And these are medically underwritten. So literally there will be an application with medical questions. It typically bypasses the employer because you don't want access to that information, but we've helped facilitate those. We've also done it in a call center where employees can call in and answer medical questions. Then that information goes to an underwriter where they medically underwrite and give you a rate based upon what they think you're gonna actually incur for expenses. Now, these are required. You have a requirement to offer at least 11. You have 11 enrolled in order to do these programs. That's a state of Maine requirement. In New Hampshire, you have to have 50 employees to offer a program like this, but Maine will allow it down to 11. There is a period of time that they hold the contract open. They call it the run-out period. So if people have claims that maybe it took them a little while to file, they give them a little bit of time to make sure they've got everything in to do their accounting. So that's something to be aware of. Usually it could be like 9 months, 12 months as a run-out period. These programs are currently subject to the PCORI fee. PCORI we thought was going to go away, and then they snuck it back in, but it's the Patient-Centered Outcomes Research Institute fee. And again, these are medically underwritten. So if your health is poorer than the average, these programs are not going to work for you. But if the health of your group is better than average, then you'll see that there's a potential for savings in these programs. All right, I'm taking a quick peek over at our questions. Okay, question from, are there any patient limitations to choosing Taro Health? Can you opt for them another provider even if your employer uses a more traditional plan like Anthem? Yes. So they are available on both the individual and the group markets. So if you are an individual looking to go towards that, you can absolutely opt out of your employer-sponsored coverage and choose to go with Taro. Patient limitations, I'm trying to think of any other way that, as long as there's availability and the physicians are able to accept patients, there shouldn't be any limitations. As long as they participate in the Taro Health Network, they're accessible. So great question, and feel free. I like to keep a conversation also. If there's anything, if you have a question, feel free to ask away. All right, so a little bit more about these level funded plans. I'm a picture person. I like to have images. So this is kind of a little bit more about how this program works. Sometimes it's called self-funding. Sometimes it's called level funding. Sometimes it's called stop-loss insurance. They're all accurate and they're all applicable terms. So even right now, when you're paying your premium, there's a portion of that premium that goes to pay for reinsurance. And that's insurance companies have other insurance companies that help them manage their risk. So in a case like this, where it would be level funding, there's a stop-loss premium that comes into play. Then there's administrative expenses. Well, somebody's got to process claims, somebody's got to answer the phones, they've got to keep the lights on and the heat on and things like that. Administrative expenses are going to cover, they're only allowed to do 20% of the premium. No more than 20% of the premium can be spent on administrative expenses, and that includes everything from even broker compensation and all of the things, any compensation that an insurance company wants to make, all of that's got to come from that administrative expenses. And then the last bucket that it can go into is a claims liability or a claim pre-fund account. So that's the amount that they think is going to be spent on claims. This is kind of a picture of how it works. So you pay your premium goes into the claims pre-funding account, and as people have claims, the money comes out of that claims pre-fund account to pay for them. At the end of the year, if there's anything left, then that gets returned to the business owner. It's really cool. I have a business that is a small business in Cumberland County that They've got about 17 employees, and they're getting about a $30,000 refund this year because they had a much better claims year than they thought it was going to be. So they can work really well if you've got a healthy group, even if it's just above average. All right, another question I see, is it essential or preferable to use a company like Taro if you see a direct primary care provider? Absolutely. If you're going to see a direct primary care provider, there's a really good chance that you're paying a monthly membership fee. And if you've got traditional insurance, you're paying kind of twice. By using Taro, part of your premium goes to pay for that membership fee. So you're definitely saving. It's going to be it's designed to work with these programs. So great question. Any questions on the level funding or self-funding stop loss model? Because that's a pretty awesome way of doing things. Nope? Okay. All right. So I wanted to, before we switch over to the legislative part of our discussion, any questions so far? See any other questions? All right, let's keep her moving. So there have been some legislative updates. First, I want to start with what did not pass, just because it's important, what's going on, what's happening, what people are trying to get through. So the first one, LD 441, is basically, you know how there's pediatric dental in the insurance programs. They're basically trying to expand it to make it so that there was adult dental as well. That did not pass. Then LD 1463, an act to make healthcare coverage more affordable for working families. So basically what that does is makes no sense, but the bill would reestablish a federal health insurance tax at the state level, and it would impose an assessment of 2.85% of net written premium on health insurance carriers to fund the family glitch, which actually they were able to address the family glitch that was previously on the individual market. If you could have it affordable for the employee, but maybe they don't pay anything for the employee's family, so it would be considered affordable, even though what the family has to pay could be astronomical. So they fixed that, so this doesn't really need to go into place because they were able to meet the need another way. And plus, we're going to save you money by charging a fee. Okay. So that's why that one didn't get passed. Now, the ones that did pass. So LD 1266, an act to require dental plan medical loss ratio reporting and review. So I was a little concerned about this. Basically, dental carriers can have a wide variety of medical loss ratios, tend to have low medical loss ratios. And health insurance carriers are required to keep track of this. Well, now they're making dental carriers do that. I reached out to Delta Dental, our largest carrier in the state, and said, what is this going to do to impact you? And they said, absolutely nothing. We're already doing it. So that was good news. Next, LD 1331, an act to make individual and small group health insurance more affordable in certain high premium counties. So this is really the people in like Aroostook was the representative who filed this. Aroostook County, the far northern states, the insurance just ends up being significantly more expensive. So they're allowed to charge a varying rate based upon geographic location. And so what they did is they changed it from 1.5 to 1 to 1.25 to 1. So the price can only differ so much based upon your geographic location. So that's going to help. Basically, it's the bigger counties are helping to subsidize the smaller counties. Is essentially what it ends up working out to. Okay, now there is a new law, LD 1776, which allows pharmacists the autonomy and ability to dispense an emergency supply of chronic maintenance medications without a prescription. So basically, if the person has a prescription on file and it's active and accurate, just because it wasn't renewed per se, maybe you're in the middle of getting a pre-authorization redone and you need your medication. Now you've got the ability to go to your pharmacist at the pharmacist's discretion to be able to give you a temporary supply until you get that prior authorization going through. So that's good for people on maintenance medications. That allows a fail-safe so that you're not in danger of having a health event because you couldn't get your prescription on. Still in the prescription world, LD 1783 requires insurance carriers and pharmacy benefit managers to appropriately account for cost-sharing amounts paid on behalf of the insured. So this is basically, it gets very confusing in terms of how they calculate a lot of the things that they do. There's oftentimes when you get prescription medications, there's rebates and things like that. So they basically created this rule to make sure that they were appropriately accounting for that. And also when somebody is getting assistance from a program, so sometimes they'll do manufacturers coupons and things like that, that you're supposed to know what you're getting to be able to accept or decline the funding. So that's an interesting new development on that front. But it's good because it gets very confusing the way that they do the accounting, and we want to make sure it's fair. So this is kind of a leveling the playing field. All right, next, LD 1910, an act to improve children's mental health by requiring insurance coverage for certain mental health treatment. So essentially, this says that they cannot deny for mental health treatment for those that are 21 or younger, as long as it is evidence-based and determined to be medically necessary. So I have a feeling, because this was passed on an emergency basis, that a child needed care and couldn't get to it for some reason. So I believe that's why this was kind of brought to the forefront. I think that that's a healthy thing to offer in any event. All right, next is LD 1357, an act to clarify health insurance coverage for postpartum care. So basically, this bill requires the maternity benefits provided by health insurers include coverage for 12 months of postpartum care that meets the recommendations of the benefits of the American College of Obstetricians, Obstetrics, and Gynecology. The requirement applies to policies issued or renewed on or after January 2023. All right, just a couple more. We're almost there. All right, so LD 1798, an act to ensure health insurance coverage for certain adults with disabilities. So as you probably know, people are able to cover their kids until the age of 26. Well, there are certain adults that have disabilities that maybe makes them fully dependent upon their parent regardless of the age. This basically allows people in that situation to stay a dependent regardless of their age. If they're unable to sustain themselves through employment in the same manner as a dependent child on the parent's policy, then that's how they're going to allow them to stay on. An act to improve access to behavioral health services by limiting cost sharing by insurers. It's a very long way of basically saying that the first primary care visit of the year, the first behavioral health visit of the year cannot be more than what they would charge for a primary care visit. So it allows, the thought process on this is if it's a copay that's preventing you from getting the care that you need, then we're going to remove the copay because we want you to get the care that you need. That's essentially what this bill is saying, which is pretty cool. Now, coming down the pike, we've got some stuff happening in 2024. LD 1539 is an act to provide access to fertility coverage. So historically, you'd need to pick a plan that operated in Massachusetts in order to have fertility coverage. Now, beginning January 1 of 2024, we will have access to fertility coverage. There will be cost sharing, but it will be a covered benefit on plans. All right, last two. LD 665, an act to promote better dental care for cancer survivors. This basically is just making sure that people that have the risk, it's medically necessary for people to reduce the risk of infection or eliminate the infection or to treat tooth loss or decay for those that have either begun cancer treatment or if these issues are directly resulted as of part of the cancer. So if I don't know if you've ever had anybody go through cancer treatment, but it can wreak havoc on your body, all of the chemicals that they make you go through. So it can affect your dental health because it can wear away at your teeth, more saliva, things like that. So this is basically just making sure that people that are negatively affected on the dental front still have dental coverage for as a result of their cancer treatment. And last but not least, LD 1003, an act to improve outcomes for persons with limb loss. So this is allowing for a one prosthetic division device designed to meet enrollees' medical needs. The purpose is for recreation. So they already are required to offer one for functioning. This is allowing them to have one to be able to exercise and do things that you can't do with a normal prosthetic. Allows them additional one. So it's pretty cool, interesting developments that are happening in the state. And it's important for everybody to be up on what's happening. And I wanted to make sure we brought this to you. So that concludes our presentation. I'm Corianne Quint with New England Financial Services, and I'd love to open it up for any questions. Feel free to pick my brain.
Well, Corianne, great presentation. I will encourage anybody who's still participating on the YouTube side of things, please submit your questions in the chat box for Corianne. She's a wealth of information. We're very lucky to have her here. Corianne, I found it very interesting. I actually belong to a PPC type provider as well. And a lot of this stuff to me is very confusing. I'm sure it's confusing to many others. That's why we have you.
Yeah.
You know where I work with the Chamber of Commerce. We have a plan with Anthem. If I wanted to go with a plan or a company like Taro, can I do that, or am I beholden to the plan that my organization chooses, or would I have to pay for that separately from what my company provides?
You would have to pay for it separately. So you have the ability to waive, but you miss any cost sharing that your employer would give you. But it is possible to decline coverage and pay for what you want. So absolutely, and people can do that as an individual.
Excellent. That's helpful. Well, I don't see any other questions that are popping through, so I'm going to say thank you once again. Hold on. We have one more question that just came through. Can you see it there?
Mm-hmm.
All right. Why don't you take this one?
All right. If my business has 40 to 44 employees, but I might upside in a couple of years, are any plans with a 50 employee cutoff worth it for only 1 or 2 years? And how would transitioning after I hire above 50? Well, really, the only thing that happens when you've got 50 or more employees is that your medical experience affects your rates. So when you cross over into the 50 market, it just kind of changes a little bit in how they calculate the rates. I would say it's absolutely pertinent and worth offering, even if it's a year or two, because that's a year or two that people are having some sort of coverage and making you more appealing as an employer. And there are ways to do it more economically. You can offer a plan and not contribute anything if you didn't want to, or you could contribute what's within your budget. I'm happy to do a review with anybody that's interested in knowing what would it look like if. And yes, I would absolutely do that. It looks like we have one more question. Is there a benefit to an employee to choose Taro if they already participate in a company HSA plan that includes a monthly employer contribution that can be used to join a direct primary care group? That's an interesting question. So if you're already in a company HSA, so Taro Health, by virtue of their plan design, is never going to be HSA compatible. So Taro is not going to offer anything that's HSA compatible. When you have an HSA, I don't think you can use HSA funds to buy your direct primary care membership. That's the first thing that pops into my mind. I would question that. I'll do that as a follow-up. I'm going to find out, because something about that doesn't sit right with me. So just the question was, is there a benefit to an employee to choose Taro if they already participate in a company HSA plan? Well, it just depends on the type of coverage that you want and the experience that you want to have. So if the direct primary care fits better with the type of care that you want to receive, then tarot is going to give you the protection on the other side, the hospital coverage, the major diagnostics, stuff like that. You just have to decide which ends up being better, because the health savings accounts give you an ability to set aside money. So that's certainly an advantage. And if your employer is contributing, then that's potentially leaving money on the table. So that's kind of I say that's more of a one-to-one meeting to work through the questions to determine what ends up being the best fit for the member. But these are great questions. Absolutely.
Yeah, and Corey, I'll say if anybody has questions after the event is over, we can we'll include your contact information in the follow-up email that'll go out. So if people do have questions, feel free to reach out directly to Corey. And if you don't mind, find out that answer about using an HSA to pay for your insurance. That does seem it seems like a tricky one. So yeah, if you can find more information, that'd be great. We'll put that in the post-event email.
Yeah, because I know you can use the money in an HSA to pay for COBRA premiums. And certain long-term care, but you cannot use it for other insurance premiums. So that's the first thing that kind of like flags, is I'm not sure that that's permitted expense, but I will absolutely use that as a follow-up.
Awesome. Oh, we got one more question here. It looks like Amy's got a question.
Yes. It doesn't begin until 2024, but it does include in vitro. That would be part of the diagnosis. The diagnosis and the assessment. I imagine it's going to be in vitro services. More information is going to be down the line. I don't want to say definitively, but I would highly imagine that would be part of it. They haven't gone into too much detail yet, but I imagine there will be more information on that coming. And that's what my gut says, that there should be something for that. Great questions.
Yeah, I want to thank everybody for great questions this morning. It's been a pretty engaging conversation. I bet you we could probably have you on, for another hour, Corey, and we'd still learn more than our minds could possibly handle. But thanks for joining us today. Great presentation. I just wanted to thank the entire Chamber staff too for helping us produce another successful event today.
Absolutely.
Thank you, Corinne. Thanks again to each of you for attending today and throughout this year. If you're interested in learning more about changes in this benefits marketplace, be sure to check your email, and there will be a follow-up message that's going to be sent with some additional links and resources like we talked about. Another shout out to our sponsor, Eaton Peabody, for their support for the Growth Basics for Business series. We look forward to seeing you again on December 20th when we hear from our friends at Marshall Communications on the topic of podcasting. The Eaton Peabody Growth Basics for Business series is typically held on the second or third Tuesday of each month. So with that, have a wonderful rest of your day and enjoy a very happy Thanksgiving.